director here at Old Capital in Dallas-Fort Worth. And, really for those who joined Multifamily 101, we discussed the basics of loans available for multifamily properties. So whether it was, recourse or non-recourse, and then also how to qualify for non-recourse financing. And in this webinar, we really are going to be discussing the intricacies of Fannie Mae loans. And so in 2018, so far year to date, I've closed 20 transactions, and of those 20 I've closed, 18 have been Fannie Mae loans. And so these loans just work really well for BNC multifamily acquisitions, as they give you max leverage, the most interest only, and then the longest amortization, all while being non-recourse. And so that's why I'm going to spend this webinar talking about what typically fits in Fannie Mae's box, but then also go into what happens if the deal falls outside of the box and how to address it. So I'm going to take you through 7 items. Number 1, loan sizing. Number 2, green program. Number 3, special cases and waivers. 4, pre-review markets. 5, prepayment penalties. And then we're going to talk about loan assumptions and supplemental loans. And then towards the end, I'm going to bring on a borrower that I have worked with over the past 3 years, and they have closed 7 multifamily properties totaling over $100 million. And they have done assumptions, supplementals, and green financing. And so they're going to be able to tell you exactly how it was, working through the process of all these different aspects of Fannie Mae loans. And so let's just kick it off now here with, really around a little bit about me and my background, just 4 highlights. Number 1, local market knowledge. Born and raised in Houston, went to school at UT Austin, lived in DFW now for 12 years. And so very familiar with the market, understand sort of the good side of tracks and bad side of tracks here in Texas. And, after coming out of school at UT, went in and worked at G Capital and spent 10 years there and underwrote over $750 million in commercial real estate. So everything from office, multifamily, retail, self-storage. I was the underwriter who put together the loan package, submitted to investment committee to get loans approved. And so very familiar with underwriting deals. And then just in the last 3 years have originated over $350 million in multifamily loans. So not only familiar with the underwriting of deals, but then also multifamily specifically has a lot of nuances on the Fannie Mae side, the Freddie Mac side. So have become very familiar with that. And the reason I started looking at multifamily was really to become an investor. And so, currently invested in about 17 multifamily properties here in DFW, totaling about 4,000 units. So understanding how to structure the debt, but also how to appeal to equity investors, as I see a lot of transactions come across my desk in terms of, whether to originate a loan or invest in a deal. And so, wide variety of background, and just wanted to give people an idea of sort of my background in multifamily. So the Fannie Mae box, I made this slide to give you an idea of sort of what Fannie Mae is looking for and what is sort of down the fairway for them. And so the first couple of boxes are really around the property. So the property needs to be 90% occupied for the last 90 days, no tenant concentrations above 40%, and then they really want a clean, stabilized property, so limited deferred maintenance, and they really don't want to finance CapEx above $10,000 a door. And so when you look at a property, if it falls outside of those items, then maybe that's not the correct, Fannie Mae deal. The second 2 boxes are really around the borrower. So they're looking for an experienced borrower, a U.S. citizen with no bankruptcy or litigation. And then they also want you to have third-party property management, especially on your first or second deal. And the bottom 4 boxes are really around the types of loan that Fannie Mae gives. So, they want the loan above $1 million. They're typically at 1-year interest only. The minimum debt service they're looking for is 125, and then the max leverage is 80%. And they provide all those things, and then they also provide what's called a supplemental loan, and new buyers trying to buy your property can also assume the loan. And so the one negative on here is the yield maintenance penalty. And so we will get into that. But if a deal fits in this box, it can be approved at a delegated level in typically 45 to 60 days. And so there are approximately 25 delegated underwriters for Fannie Mae loans. You know, banks like CBRE, JP Morgan, Wells Fargo, those are some of the bigger name ones. So if a deal does not fit in the box, however, for one reason or another, it has to go to Fannie Mae for a waiver. And so that's what we're going to talk about. You know, there's waivers that improve the loan, such as interest only, but then also there's waivers that just to make sure that Fannie Mae will do the loan just in general. And so this first box, you know, when underwriting a property, investors will come to us really for a debt term sheet. So they want to understand how the lender is going to underwrite a property. And so on this first slide, we're going to talk about how do they actually size the loan. So that minimum 125 debt service, how do they decide that and how do they come up with it? So there's 3 columns on this slide, and it's really around the T12, the T3, and then what the lender is going to use for their underwriting. And so to start at the top, the net rental income, they're going to look for the T3. So the T3 annualized is that second column, T3 annualized, and on the net rental. And then other income, they're going to look at T12. So if you can see on this example, T12 other income was about 193,000, and that's what they underwrote. And so you have a T3 net rental, T12 other income. And then on expenses, this is where they have a lot more flexibility. So they're looking sort of in the rear view mirror for the revenue, but on expenses, they can look to your actual budget. And so for admin, advertising, marketing, payroll, R&M, they can go actually to industry averages. And as long as your budget reflects those, they can underwrite those lower numbers. So let's look at example on, let's say payroll. The T12 was 127,000, but your budget is 121,000 or 1,000 a door. So that actually allows you to underwrite a lower number. And so your budget is actually very important in the Fannie Mae underwriting process. And as you go through the expenses, they're going to look at your budget. But for some items, they will only use historicals. And so that is really around utilities. So things like water and sewer, electric, those things will be based on T12. And so you can see on this one, utilities are about $156,000. And so they are going to use that number even if your budget is lower. And so on the T12, that's what it's going to take on utilities. And then the 2 last items here that you know, people sometimes will get confused on is insurance. So insurance is going to be based on the actual insurance quote that you receive based on meeting all of the guidelines. And so in DFW, you might have 250 to 300 a door, but it might increase to 400 or 500 a door if you had a recent fire or hail claim on the roof. And so understanding what your insurance is, and then also your taxes. So taxes are a big thing here in Texas. They are going to be reassessed by the lender typically to 75 to 80% of the purchase price times your tax rate. And so understanding what the reassessment is for that county and making sure that you do that when you underwrite the deal. And the last item here is replacement reserves. So they're going to look at what CapEx is needed in the next 12 years, let's say, on a 10-year loan, and determine what, the future CapEx of the property, but then also looking at, they're going to divide that by 12 and then also divide that by the number of units to determine your replacement reserve. So replacement reserves on this one were 300 per unit, and that is pretty typical on sort of your B minus C properties out there. So, top line revenue on this one minus your expenses minus your replacement reserve gets you to a net cash flow of 599. And then on this property, the debt service was 479. So this is how you would size the debt service to a 125 on Fannie Mae. And so before investors really submit an offer, they request a debt term sheet, and then we will underwrite the deal and send them what loan proceeds are available on a property. And so this is, as interest rates have risen though, this has become tighter and tighter. So we used to have full 80% loan to cost, but on a lot of deals now it's closer to 75% loan to cost. And so let's go through the next item. So as you look at, getting the best loan proceeds for your deal, a new program that just came out a couple years ago is really the Fannie Mae Green program. And so you're able to qualify for this property by reducing either water or electric by 25%. And this can reduce your interest rate by anywhere from 10 to 33 basis points, depending on the size of the loan. And so, in order to engage in this process, really, you have to order a third-party high performance building report when submitting your loan application, and then submit 12 months of utility bills and go through a site inspection. And this report actually details what you need to do to qualify. And so I wanted to show you guys an example of what comes back in a green report. So, on the top, they really focus on the electric side. So to qualify for the electric on this deal, you also would have to replace, you would have to spend close to $500,000 on windows, lighting, water heaters, HVAC, and that would just not be feasible for a lot of investors. And so nearly every deal that we are working on is qualifying for green based on water savings. And so if you look at the right-hand side, highlighted in red, it shows the items that on this deal that the owner had to complete. So low flow faucets, shower heads, and toilets. And so that was approximately $100,000, but they got 33 basis points off of their interest rate. And so that is a huge thing, reducing the utility expenses, improving their NOI, and typically this is built into people's capital plan already. And so, we've covered how to underwrite the cash flow of a property and then also how to qualify for the green program. But another determinant of your loan proceeds is where the property is located. And so the next thing that we're going to cover is pre-review markets. And pre-review markets are determined by Fannie Mae, and this can impact your LTV greatly. And so pre-review markets are determined by the industry concentration, or if Fannie Mae has a large concentration in that market. And so when it is pre-review, it typically is 5 to 7 business days longer for your approval. So it is not a delegated approval, but it is it has to be sent to Fannie Mae. And there's really two levels. Level one, they say, is on the left-hand side of the screen, is 65% loan to cost is delegated. Anything above that would not be. And then level two, which is even worse in Fannie Mae's eyes, is nothing is delegated to the underwriters. And so everything must be submitted to Fannie Mae in order to be approved. And so essentially they're saying, we don't want any more new deals in these markets. And so I highlighted some of the red markets that on here that we run into a lot of the times here in Texas and surrounding states. The big one here is Houston. That is, in that market for that deal size, a lot of our borrowers have started going to Freddie small balance or a bridge loan before Fannie Mae at lower leverage later on once they come back for a refinance. But on acquisitions, they're using Freddie SBL. And so whenever a loan doesn't fit in sort of the standard Fannie Mae box, we apply for what's called a waiver. And so that's the next piece that we're going to talk about. So on the right-hand side, we talked about, in the box, 1 year interest only, no tenants concentration above 40, and then limited CapEx. The big thing here on interest only, and this is where a lot of people are getting hung up right now, is there's really three things that people or Fannie Mae is looking at when they're granting interest only. Number one, borrower's experience. Number two, the exit analysis based on the LTV, the initial LTV of the property. And then three, the age of the property. So the more experience, the lower leverage you start at, and the newer the property, the higher probability that you will get more interest only. And so Fannie Mae is really looking at whether you can finance the loan at 75% at the end of the loan maturity. And so the lower leverage deals, you can even qualify. Let's say you take a loan at 65%, then you can qualify for, full term IO. And so they're really looking at where's your LTV starting and where is it going to end at the end of the maturity. And a couple of these other items that we've run into: tenant concentrations, capex greater than 10,000 a door, and then scattered sites. Those items really, when you start looking at new deals, it's important to keep these things in mind and ask the question to the listing broker around these things. So tenant concentration, especially let's say in Killeen or in smaller markets where a lot of the employment's coming from one source, understanding how much of the tenant base, understanding the leases in that area is key. And then also around the scattered sites, we've run into some issues where, similar to this picture, you have properties that are sort of in between your property. And if you do not own all the properties, it doesn't look like one community. Fannie has declined deals in the past because of that. And so, in addition to these property items, another thing that Fannie Mae really looks for is around the borrower. And so the three things here that we're going to highlight is number one, U.S. citizenship, number two, bankruptcy, and three, third-party property management. And so, if you do not have U.S. citizenship, what Fannie Mae is going to look for is how long have you lived in the U.S.? Do you have personal residence? Have you bought a house here? And do you work in the U.S.? And so we've worked with investors from Canada, Japan, Australia, China, and gotten opinion letters from those countries and gotten those deals approved. It typically just adds 5 to 7 business days to the approval. And then the bankruptcy and litigation, please disclose that upfront if you've had any issues with that in the past, as they will run searches on anybody with more than 25% ownership or management control on their key principles. And so that is very key. They won't necessarily kill the deal, but it might reduce the leverage on it. And the third thing here is third-party property management. And so they definitely prefer someone who has managed hundreds, if not thousands of units in the market that you're purchasing in. And it only really makes sense to self-manage once you have maybe, at least 5, if not 10 properties. And it makes more economic sense for you to maybe hire a regional manager. But at the beginning, especially on your first or second property, third-party property management is key. So when you complete a loan application for a Fannie loan, these 3 items they're gonna definitely ask you about. So, while we've covered a lot of the good things about Fannie Mae loans, so non-recourse, interest only, rehab rolled in, but one of the more challenging or negative things about Fannie Mae loans is a thing called prepayment penalty. And specifically for Fannie Mae, it's yield maintenance. And so when you're looking at the 2 types of prepayment penalties, the most common are step down and yield maintenance. And so step down is very simple. So let's take an example of step down. You're just going to take the loan amount and times it by the loan percentage, and that typically is based on the loan year that you pay off the loan. And so on Freddie small balance, you have on a 10-year loan 5544332211 on a 10-year loan. And so let's say, for example, on a $3 million loan paid off in year 5 on a 10-year loan, then you would have a $3 million times 3%. And so your loan penalty or prepayment penalty would be $90,000 in that example. And so this is pretty straightforward. You can typically get this on the Freddie SBL loan, but on Fannie Mae loans, yield maintenance is definitely the most common. And so yield maintenance is actually dependent on 3 things. Number one, the years left on your loan, your interest rate currently on the loan, and then what the prevailing interest rate for a similar maturing treasury. And so in this example on the right-hand side, you can see that this loan was originated back in 2011. and now we are prepaying it, 5 years into the loan. And so there's still 5 years left on the maturity. And the prepayment penalty they calculated was $490,000 on this $3 million loan. So 16% of the loan amount was the penalty, the prepayment penalty. And so there's a dramatic difference just between step down and prepay. And so I put a website on here for people to take a look at. It's called defeaswithease.com, and you can actually plug in your loan terms and then actually get just an estimate of the prepayment penalty for your particular loan. And so that's a good resource for you as you're looking to sell your properties and trying to understand sort of what the prepayment would be. And so, understanding that yield maintenance is expensive, this has become more and more of an issue as buyers are having to assume Fannie Mae loans. And so I wanted to show an example here on a lot of deals in today's market are coming to the market with two prices. The purchase price of $10 million on assumption or $11 million on new debt. And so I wanted you guys to think about this out there. And if you saw this and a listing broker was bringing you this deal, how would you approach it? And then let's talk about what the best way and this is very similar numbers to a deal that is currently on the market. And so they could buy the deal for $10 million on a loan assumption of $5 million with a supplemental loan of 2.5, so a second mortgage of 2.5 at 6%. And so total loan of 7.5. And so they would be at 75% of the purchase price, but there'd be no interest only left on the loan. Or they could take the deal, new debt, $11 million, and the new loan was sizing at $8 million at 5% with 1 to 3 years interest only. And so put in the chat box what you think would be your preferred method. So whether it would be $10 million on assumption or $11 million on new debt. I'm interested to see what you guys think would be more advantageous. And so I'll give you a minute here to put in the chat box what you guys think would be a better option. So I'll give you 30 seconds here to look at these two and depend. So almost everybody from the beginning really liked new debt at the beginning, but now we're seeing some loan assumptions come back. Okay. So before I give you the answer of what the buyer actually did, let's look at some pros and cons of the loan assumption. So number one, lower purchase price, since you don't have to pay, the seller won't have to pay the prepay. Number two, the interest rate on the existing debt is actually lower. So the blended interest rate would be even lower than the current market interest rate. But some of the disadvantages, you're limited to 75%. There's no interest only. There's typically no money for rehab. And then that loan term might not match your investment horizon. So if there's only 5 years left on the loan, then and you run into a recession, then your property might not be able to refi. And it does take typically at least 60 days to 90 days on an assumption to get the deal done compared to new debt. And so it definitely is tougher. So let's go to the next slide to see what the buyer did on this particular deal. So in this one, they actually went with the assumption. And the reason being that the new debt, so when you actually look at the new debt, the $11 million, compared to the $8 million loan, it's only about 72% of the purchase price. And so if you were able to get $9 million, say for example, on the new loan, then it might be a better opportunity. But the buyer chose the loan assumption, you get the lower basis, lower interest rate, and somebody actually had this comment was, as long as your investors are willing to accept a lower cash on cash, so 5 to 6% versus maybe 7 to 8% on interest only, then it actually works. So you're going to have to get some of your return on the back end of the deal. But in 2018, just like in the next 2 to 3 weeks, I'm closing like 3 loan assumptions. And so it is definitely, as interest rates have come up, it has become a bigger and bigger part of acquisitions. So back in 2016 and 2017, I remember like 90 to 95% of transactions were going new debt. And that was because you could get more interest only, but then you could also get close to 80% loan to cost on every deal. And so you just have to run it both ways and figure out what works best for your investors. So last item we're going to cover, and we briefly touched about this on assumptions, are supplemental loans. And so supplemental loans are available for new buyers who are assuming a Fannie Mae loan, and also for you, if you already own a property and the property values have improved, then you can take a supplemental loan out, and this can actually be sort of a second mortgage or similar to like an earnout that a bank would give. A couple things to note: you need at least 5 years left on your maturity, and then you are going to size the debt at 1.30 instead of the 125 that we looked at. And so there is a cost. It is a new loan, so there's going to be legal costs, third-party costs, and typically the interest rate. So the interest rate on most, let's say it's 5% today on most deals. On a supplemental loan in today's market, you're going to be looking at closer to 6%. So it is a second mortgage, and it is more expensive. And so definitely keep that in mind. It is a huge advantage for Fannie Mae, but you will have to go back to the same DUS lender or delegated underwriter as the first mortgage. So that's the only person that can do a second mortgage on that deal. So now I wanted to bring in Ken Yu, who's here in the studio with me today. And I just, I've worked with these guys for the past 3 years. They have closed over 1,000 units, raised over $25 million in equity, and have closed on over 100 million in transactions. And so I wanted to bring them on for this webinar because they have not only done assumptions and supplementals, but on the last 2, they have done green financing. So let me bring them on. So welcome. I was about to say welcome to the podcast, but welcome to the webinar, Ken Yu. So why don't you bring a chair over, and we'll put you right in front of the mic.
Okay. So hi everybody this evening. So before I kind of go through my background, I just want to take this opportunity to thanks Old Capital. Thank you, James Ng, and thank you, Paul People. Without them, I probably could not have done all these deals. They have brought so much value to me. Not only they help me underwrite, they also give me insights on the property, the submarket. So thank you, James, and thank you, Paul. And I'm really excited to come in and kind of share my experience here, because this is kind of my way to kind of give a small something back to Old Capital and James. So my background is technology. I was a software engineer for over 30 years, but my wife and I basically really like real estate as an investment. So we always have owned real estate properties. I own rental property in Texas, and my wife own property in Hong Kong and in China. So about 2009, and that's when we really kickstart our our real estate business. We between 2009 and 2013, we bought and managed over 70 single-family houses. So to scale up even more, we transitioned to a multifamily, and that's how we get started.
So Ken, so you said 70 single family houses. That's a lot of doors. The, as you started moving into multifamily, what was the first purchase that you guys made?
The first property we made was a 105 unit property inside West Fort Worth. It was about $4 million. Um, it was okay. It was a Fannie Mae loan, because we choose a Fannie Mae loan because exactly what all the highlights that James just talked about. It was for safety, because we invest a lot of our money in along with our investors' money in. So we wanted to have a long-term investment um, going forward. And if there is a downturn on the economy, we were able to ride through it. So that's what we choose.
So on that first loan, you guys bought it for about 4.2 million, you said, and then you put some rehab dollars, I think 300,000. And then what were you able to sell that property for? Do you remember?
So we ended up selling that property for 6.2 million. So the total return for everybody invested in that property is 120%, a little over 2 years. So
Wow, so that's great. So after buying that first property, what was the second property that you guys bought?
so we bought another property shortly after we bought the first one. And we also choose to go with the Fannie Mae loan route. It was a new debt. We bought that property for $9 million. And in about, again, 2.5 years, less than 2.5 years, we sold it for like 14 million, and everybody invested in that property made 150% on their money.
So those are two deals that you went full cycle on. So a couple of these properties that we have on the screen, the Loop, Tierra del Sol, Wedgwood, Villa del Sol, those all had loan assumptions, and then you were able to add a supplemental on those Fannie Mae loans. So talk about that process and those acquisitions.
Okay, so kind of exactly what you pointed out early in your all your slides. So we were able to purchase. We were able to choose the assumption route because it offers a lower price, and the loan to value was actually kind of close to new debt anyway. And the new debt on the new loan would be a lot more high because the prepayment penalty was over $1 million for some of these property, over $2 million some of these. So we choose the assumption route, and because you have to assume the loan and you also have to apply for a supplemental. So there's more paperwork to be involved and more fees. But end of the day, if it works, it's all worth it.
So on those properties, you're really gonna not only take the property, do the assumption supplemental, do your rehab plan, but now those properties probably have 4 or 5 years left on maturity. So the next person, when you go to sell, you'll probably just offer those free and clear, right?
Correct. So that's kind of like a hidden advantage of doing an assumption. If you can make the deal work initially, as James mentioned earlier, the cash and cash part of it has to work and the overall return has to work. And if you're able to do that, then at the back end, you will have a product that you can sell free and clear and you get at higher prices. Yeah.
Okay. And then on the last two transactions, so we got one of them on here, Toscana, but then you just closed Point on Callaway. So both of those were, 150, 200 unit deals, and they were new debt, and you guys utilized the green program. And so tell me about sort of what your experience was on that.
Okay, so actually it went pretty smooth. It just involved additional fees that we have to pay up front to get the green program. So normally they come back with a report, and as James pointed out, that really the only thing that cost effective to do is really the water conservation part, because all the other part is just too costly. So we set aside some money for changing out the shower head, the aerator, to qualify for the program. So we bought those two property this year, so we're still in the process of implementing the green program. but it's all worth it because it got our interest rate lower, and so our payment is lower, and we can raise less money, and as a result, our returns are going to be higher. So.
Okay, great. And then, so on those two deals, Toscana and Callaway, not only did you get the green program, but we were able to get you 4 years interest only. And so talk about how investors looking at the deal really appreciated the extra years of interest only.
Yeah, so we're in a really, really hot real estate market. So prices going up and up. So to get interest only is really going to help your cash flow. So I was able to kind of tell that story to our investor that we're still going to get a nice cash and cash return, and they make the deal more attractive and help you raise money to close the deal. So.
And then, so there's a lot of general partners out there attempting to raise equity for their deals in today's market. And so maybe give us one or two things that differentiate you guys from the other general partners in the market.
Okay, so I think what set us apart is really we're investors first. We started out as investors, so we look at all the deals from an investor's point of view. So some of the things that as an investor that we want, we try to do as a sponsor. For example, we will try to put a lot of our own cash into the deal. On our very first property, we only had to raise about $1.25 million, and we put in like $250,000 of our own money into it. So that's a lot of these other deals out there, they may not be able to do that. In addition, all our investors we have a personal relationship with. It was just not a name out of a mailing list. So that's kind of what set us apart.
And so if people are interested in learning sort of about your experience working with Old Capital or possibly looking at a deal with you in the future, what's the best way for them to reach out to you?
It's probably the best way is probably go to our website. My daughter's favorite song is Twinkle Twinkle Little Star. So our company is Twinkle Star Asset. So you can go to our website, twinklestarasset.com, and we have our contact information there.
Great. Thanks a lot. Thanks a lot, Ken, for coming in to the studio to just really share your story. I think, one of the unique things about them is that they have been at this for a while now, but then also the ability to get deals under contract, work with the listing broker. And I mean, I think every listing broker in the DFW market appreciates how you guys work, and every deal that you get under contract, you close. And there's just, it's very smooth working with you guys. And so I appreciate all the business. So thanks a lot for coming in.
Thank you.
So next, we're just going to wrap up sort of with what Old Capital does and sort of why investors trust us with their transactions. So, in 2017, we closed over $750 million in loans. And in 2018, we're closing in on $1 billion. And so our job is to get the deals closed. And, on the right-hand side is 25 of the 40 deals that I closed last year. And so as you can see in that picture, a majority of these deals are, B and C properties across the US. And so we close close to 20 loans a month. So we know which lenders are the best for your transaction. And so, a couple other reasons people choose us is best loan terms and rates. So we meet with lenders out there every week, exploring sort of what the best rates are in the market, and then really keeping in front. So Fannie Mae is constantly changing, whether it's green requirements or pre-review markets, understanding what the best lending options are out there, because a lot of deals you can see, number 3 is really on time. When you go under contract on a property, you cannot go from lender to lender. A majority of these deals, your earnest money is going hard in the first, 1 to 14 days, and that can be anywhere from 1 to 3% of the purchase price. And so really understanding, based on the property's occupancy, submarket, and your experience level, we're going to determine what the best lender is. Number 4 is really, my experience as a former underwriter, understanding what the bank needs and then when they need it and why they need it is key. So, I've been on the other side of the table trying to get deals approved, loans approved through investment committee. And so I sort of help you through that process. And so the knowledge set that I bring is key and around getting deals closed in that 60 days. And then the 5th really is inside information. So, I mean, we do 1 out of every 3 BNC apartment loans here in DFW, but then, we have a wide reach across Texas. And so, bring us in early and we can typically find out more information about the property and then also the listing broker and then possibly even the seller. And so, get us involved early in your transaction. A couple things on how to connect with us. Number 1 is the podcast. So if you go on to iTunes and subscribe to the Old Capital Real Estate Investing Podcast, there was over 100 interviews with owners, listing brokers, vendors, lenders, and we put out a new one every week. So definitely check that out. Second is the Facebook page. So if you go on there, real-time updates, videos, meetings with listing brokers. We've been recently doing a little bit of Facebook Live with our lunch and learns and things like that. That would be good for you to watch if you can't make it to Dallas for a specific event. And the third thing really is our annual conference. So Thursday, September 13th at AT&T Stadium. This is really, we're probably going to have close to 500 investors at this event. So listing brokers from all over the area, lenders, property managers, owners, and then a keynote from Roger Staubach, and it'll all be hosted at AT&T Stadium on September 13th. So you can go to oldcapitalpodcast.com or we will send the slides out for this deck, but there's also a link to the Eventbrite registration page there as well. And then the next day after the conference, we're going to have a couple bonus sessions. In the morning, we're going to have open houses with listing brokers. So actually at their office, going and meeting some of the top Dallas brokers, and then also a syndication event with Jillian Sidoti of Crowdfunding Lawyers at the Addison Conference Center on Friday. That one is a workshop on how to raise equity correctly. And so that is the last thing on how to connect with us. So the podcast, Facebook page, and then the conference. And then now we're gonna open it up to Q&A. I know we have a little bit of time before 8 o'clock, so I wanted to allow people to ask some questions. So if you have any questions about the material we've covered so far, go ahead and put it in the chat box. I know we've gotten some questions that came in already, and I just wanted to give people a chance to ask any questions now. So go ahead and put those in the chat box, and then we will go through these questions. So I'll give you guys a minute to ask your questions, and then we will jump back on and answer these questions. All right, so a couple questions that came in. We are going to be recording the webinar, so we'll record it and put it back online and send it out to everyone who registered. Second question is around tenant concentration. So we talked about any more than 40% of the tenant base. So a good example of this is, let's say Killeen, there are a very large concentration of military in your property. And so if there is a deployment or some sort of change in the base, the military base in that area, all of a sudden your occupancy can go from 90% down to 60%, and that can materially impact your ability to service the debt. And so they look at military concentration, but then also another thing on tenant concentration, they look at employer concentration. So when you're looking at the leases for a property, understanding where are all these tenants working. So if a larger employer, I mean, the easiest example is maybe something like in Detroit, where there is a large, let's say, Ford or GM plant, and all the tenants work in that area, then that is a very large tenant concentration. All right, next question is around the Fannie Green program. And so the Fannie Green program, the question is, do they look at the historical expenses, historical utilities to determine the reduction in water? So yes, they do. So they really have a lot of examples of where they think water could go, and the reduction that you can achieve by doing these items. So when the Fannie Mae Green programs, when they go out there, they look at the historical T12 for water and sewer and electricity, but then they also look at what can be achieved based off of what has not been implemented. And so when you're walking these properties, a lot of times we're looking at the toilets, we're looking at the faucets, and we're looking at the shower heads to determine that. Okay, and then this next question is, would Fannie Mae ever approve a loan for a first-time investor? And I would say that depends. It depends if that first-time investor is partnering with a more experienced investor. And so Fannie Mae won't do a loan for an investor who has never owned a multifamily property. So you typically have to partner with somebody else who has Fannie Mae or multifamily experience, and then you can do the loan. All right, next question. What's the longest term available for Fannie and Freddie? Are there any permanent non-recourse financing options out there? So on this, you can actually, so most people are doing 5-year, 7, 10, and 12-year, with the most common probably 10 and 12-year. There are options out there where you can get 30-year amortization and 30-year term with 30-year amortization. So, but the problem with those is typically the pricing is higher. So, today on a 10 or 12-year deal, it might be 5%, but then if you put a 30-year loan on it, it might be closer to 6%. So your leverage is impacted greatly, and then the yield maintenance would also be a longer term. And then what is the prepayment on supplemental loans? On supplemental loans, the prepayment is yield maintenance as well. So that first loan that you have on the property, let's say there's 7 years left, and then you get a supplemental loan, that supplemental loan will be coterminous with the first loan. And so it is the same prepayment penalty. It is a yield maintenance prepayment penalty. And so a couple more questions here. Question for Ken. You want to come back on with me here, Ken? So it says, are all of Ken's deals in DFW?
Yes. All our deals are in the DFW area. We always think that DFW is kind of like the best apartment market. So why go somewhere else to a market that nobody know us or done business with us before? So I don't want to give away that advantage. So I foresee myself continue to invest in the DFW area.
Yeah, so especially as you build sort of a resume and track record, a lot of these brokers that have transacted with Ken already, they continue to bring him deals either off market or even when a deal is marketed. It's a lot easier to transact with people that you know already. All right, so this next question, what qualifies as Fannie Mae experience? So that is really, Fannie Mae is really looking for 5 units or above in multifamily experience. And they really want you to own something of similar size. And so if you're trying to qualify, you can't go buy a 5-unit deal and then 6 months to a year later try to buy a 200-unit deal. it has to be of comparable size. And so a lot of these properties that we finance are put together by syndications where similar to in 101, let's say you're buying a $5 million deal and you need a $4 million loan. Most people are partnering with other people. And so when you're looking at partners, understanding, what else they're bringing to the table, whether that's net worth and liquidity, but also have they signed on a Fannie Mae loan of that size is very key. And so that's a big issue to address when you're putting together your sponsorship group. So this question's around, are there any loans available for first-time investors? What would you recommend? So my recommendation on that is if you want to stay non-recourse for your first-time investor, I would look at Freddie Mac small balance loans and probably look at the recording for 101. That has a lot more detail on Freddie SBL or Freddie small balance loans. That's a non-recourse option for first-time investors, and it is, pretty similar terms to Fannie Mae loans, but you do not get to roll the rehab into the loan. You have to raise the rehab out from equity, in essence. The only other option out there really is a bank loan. So if you're comfortable with a recourse bank loan, then that would be another option for first-time investors, because the recourse bank loan, they're going to look probably 50% at the property, but then also 50% at you, the investor, and look at your tax returns. And so for first-time investors, a lot of people get started with a bank loan. And so I think that also addresses this question, the key differences between Fannie and Freddie. Fannie is going to roll the rehab into the loan and Freddie will not. And so that's a big item. Let's see. All right, if you guys have any more questions, please type them in the box. I think we covered a majority of them. So this is a good question, actually. So what is the process to view your term sheet? So we talked about this in the webinar about, we underwrite the deal and we'll look to see and size it to a 125 debt service, and then we will send you a term sheet. And so, the best way is for number one, to fill out your personal financial statement and then send it in to us and set up some time with myself to go through your personal financial statement and what deals you can qualify for. And then once you've done that, then we'll qualify you for a certain amount of loan. And then when you go out and actually make offers on deals, you can send us the current rent roll and then the trailing 12 financial, along with either the offering memorandum or the address of the property. And then we can put together the term sheet for you and send it back, typically within 1 to 2 days. And so that would be the, best way in terms of getting a term sheet. So Gary, I see your question here. So what his question is, for someone syndicating the equity. So for example, let's say you're buying a $10 million loan that we talked about, or sorry, $10 million property, and the loan is $8 million. How do you, as the syndicator, show proof of funds since you're raising the money? So you don't actually have the equity yet. And so my best recommendation for that is when you have your group of key principals, then from that group, let's say there's 4 people, from that group, I want to show that I can raise a good portion of that equity. If you can show that between you 4 KPs signing on this deal, that you have $2 million in liquid cash, that makes the listing broker and the seller a lot more comfortable that you can raise the money, but then also if you can't raise the money, then you guys will be able to close the deal with the cash you have on hand. So that is my best recommendation in terms of proof of funds. All right, we've got a lot of questions here. What we're gonna do is download all these questions. We'll answer all of them, and then send out a FAQ for just the answers to these, and send it out to everyone who registered. And so, thank you guys for joining. In terms of next steps, really, number one, education. So if you've hung on this long, definitely subscribe to the podcast, like our Facebook page, register for the conference. I think those are, very easy things to do, and you can get a lot of information that way. Second thing is complete your personal financial statement, set up a time to talk with me, and really get your questions answered so that when you're going out there and meeting listing brokers and underwriting new listings, you can sound credible and you know what you're talking about in terms of Fannie Mae loans, Freddie Mac loans, and understanding what the debt structure is for a particular deal. So once you start underwriting deals, making offers, start really building your team and have a strong sponsorship group with good resumes and proof of funds. And last thing really is to close the deal. And so, going from 0 to 1 is key. After you get that first one done, it becomes a lot easier. So thank you guys for joining. I appreciate everything, all you guys' questions. I will answer them here tonight and send it out here by the end of the week, a recording of this webinar as well. So thank you guys very much.